Under the Radar report's going through a portfolio refresh because, as we all know, one stock is just a part of many stocks in a portfolio, and on the other hand, at the other extreme, I guess you can't buy every stock that Under the Radar recommends. So each stock has its place to play in a portfolio. And this week, our portfolio manager goes in depth in terms of explaining how to run and maintain a portfolio. So it's a big deal with lots of graphs, lots of charts, and lots of commentary. In terms of diversification, that's a key thing in any portfolio, but I'd say that if you're at the start of the mountain learning to invest in stocks, just invest in one stock, because it's important to learn, what your risk tolerance is, and just in terms of the mechanics of investing, it's best to start off with one. But in terms of diversification, as we've always said, 7 stocks is the minimum, 15 stocks is probably too many. Well, in terms of ETFs or exchange-traded funds, these are funds in which the value of all the assets are provided to investors and trade up or down depending upon the changes. And you need liquidity and you need transparency. Both of these things, liquidity and transparency, aren't readily available in small caps. So you won't find a small cap exchange-traded fund. We look at all the various valuation methodologies, PEs, EBIT multiples, DCFs or discounted cash flows. But I'd say that in reference to someone asking about NTA or net tangible assets per share, it's that methodology is less prevalent now because it's just harder to find companies trading at a discount to their net tangible assets, which reflects the way I guess the economy's transitioned away from manufacturing towards intellectual property, like the rise of the Googles of this world and the Amazons, where their intangible assets form a greater place on the balance sheet. So we still look for companies trading at a discount to NTA, but they're not as easy to find anymore. We think that you need to own a number of, if you are going to dabble in the speculative world, and there are a number of speculative stocks that we look at, like Vmoto, and there was a question about that stock. The thing to remember is with speculative stocks is that there's not much transparency. And with Vmoto, it's a great concept. They have electric scooters running around in China. I don't think I've yet met a person who's seen one. But the thing is that there isn't much transparency, so you really are in the hands of the company, which is why we like companies with strong cash levels on their balance sheet and that are paying out dividends. The mining services sector is very leveraged because it relies upon short-term or different lengths of contracts. So what's happened is that this sector's experienced a severe downturn, and certainly the stocks that we've supported have been those that have almost fortress-like balance sheets and have been what we've perceived to be the best, the best in show, the strongest. And these companies are now starting to see a bounce, and they're starting to deliver good dividends to shareholders. So stocks like Southern Cross Electrical Engineering starting to bounce. Logicams is struggling away, but I think if the mining services company is a survivor through this downturn, then it will have reduced its cost base, and it can provide leverage for making good returns from here, hopefully. Well, we did say take profits with the gold stocks a few weeks ago, and they've come off 10%, and we think now investors should start nibbling. And when we say nibbling, the gold stocks that we like are multi-mine operators, because there's too much risk in owning a one mine company these days. We've mentioned Northern Star, Evolution, and Doré Minerals, and they're still our favourite gold plays. Plus, the portfolio owns some gold bullion ETF, which we think is a good idea. We think that there's value in the gold stocks, and we like the thematic of gold because of the uncertainty relating to monetary policy around the world.